Hey there, everybody. Happy Wednesday, March 12th. Happy hump day. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully overcast and kind of chilly Redmond, Washington. Great to have you join me here today. And every weekday after the close, as we break down the market action on our market recap show. Had a lot of fun earlier today. I don't know if any of you were able to join me on the Money Show Virtual Expo. I shared a presentation. It was a sprint. It was a 30-minute sprint through a presentation I entitled The Four Deadly Sins for Investors. We talked about some of the timing issues we often have in our portfolios, struggling to be patient and wait for the right opportunity. So if you did participate, I hope you found it enjoyable. Keep your eyes peeled, and I'll certainly be letting you know here on the show when I'm doing future events. We'll see. I'm actually working. There's a July Money Show event in Las Vegas. Seeing if my calendar will be open to that particular trip being added, but to be determined. Thanks for joining me here today. I mean, boy, a choppy sideways market. I'm looking at today. I'm looking at the chart of the Dow just over the last 2 days, and it's just kind of this choppy digestion phase here. Big down day on Monday. Now we're sort of chopping around. Out of the open, inflation data coming in a little cooler than expected. Boy, it felt like that might be the beginning of a nice recovery. The Dow finished in the red, the Nasdaq finishing in the green, but Nasdaq in the red the Dow in the red, and about half the S&P sectors up, half the S&P sectors down. So this is very much a mixed results kind of day as we get to our market recap, and let's look at how things played out. Here's the 2-day chart of the Dow that I was mentioning, kind of chopping around sideways. The Dow finishing down 0.2%. The S&P 500 0.5% lower. Lord, 0.5% higher. Look at the color, David. 0.5% higher to just slightly below 5,600. The Nasdaq Composite leading the way up, about 1.2% higher. You're going to notice the FANG sectors back at the top of the leaderboard. That has not been a frequent occurrence here in 2025 thus far, but that's what we have. On Monday, it was those three FANG sectors at the bottom of the list. Today, kind of leading this bit of a bounce here, what I would probably loosely call a dead cat bounce until proven otherwise. I would say this feels like a counter trend rally after a big down day. Mid caps and small caps both in the red. Small cap stocks the worst performers today, and the S&P 600 small cap index was down about 0.5%. The VIX moving about 2.7 points lower. Now the volatility of the VIX is pretty elevated. So we're seeing big moves in the VIX day in, day out. So it feels like that's happening. That's absolutely true. We're still kind of in the mid-20s range, which by my read, anything over 20 is a high volatility environment. All right, continuing on here, let's look at the bond markets. We can see generally higher. You can see 5, 10, 30-year interest rate points all drifting to the upside. We can see the 10-year point currently around 4.3%. Long bond yield just about 4.6%. Bond prices, of course, moving lower. The TLT was down about 0.6% to just below $90 a share for that ETF. Dollar, no real change too much, right? I mean, the dollar basically flat from yesterday's close. The downtrend in the dollar has been a key change in 2025. And again, think about, I think when you look back at this major top that we've, sort of experienced, or at least what looks to be at least a significant top as future history books are written, I think it's always important to look at what changed from Q4 of 2024 to Q1 of 2025. And I think the dollar being so strong going into year end and being so weak so far year to date, I think is one of the most significant shifts that I've certainly observed among many. I mean, we've documented, I think, a lot of these on the show over the course of day in, day out, week in, week out. But I think the dollar index shifting, certainly in my monthly chart review that I do with my market misbehavior premium members, that change in the dollar trend is one of the most noticeable, I think, inflection points that we observed going into this year. Looking at the commodity space, I actually grabbed a couple commodity charts today just to address a little further. Generally speaking, commodities higher today, although natural gas prices moved down a bit. Overall, we're seeing some nice uptrends here, and gold and silver continuing to experience a strong uptrend. Gold prices up about 0.4%. Copper, crude oil, all up to the upside today. Looking at the cryptocurrency space, again, pretty choppy, similar to what we're seeing in the equity markets. Bitcoin currently trading just above 83,000. That's up slightly from the end of the day yesterday. Ethereum price is moving lower. There's a big divergence right now between Bitcoin and Ethereum. Both of them, I would say, generally in a position of weakness, but Bitcoin kind of outperforming Ethereum. The chart of Bitcoin looks okay. The chart of Ethereum not so okay is the way I would gently describe the difference. We can look at those a little further, time permitting, but that's one observation that I'm making. Someone mentioned a while ago about looking at Bitcoin, the Bitcoin Ethereum ratio. That might have been like JC Peretz that have floated that a long time ago. I haven't kept super close ties on that, but I'm verbally reminding myself to take a little further look at that. All right, looking at the 11 S&P sectors, we can see the FANG sectors at the top of the list today. So general playbook, after you've had a big 10% drop in the major averages, you probably get a counter trend rally. It's probably led by the things that got beaten down the most. So a bounce this week driven by the growth sectors pretty much fits what I would expect. The real question is what happens after this, right? The big leg down has now happened. We're going to get a counter trend rally. And I think the real question we'll probably be struggling with is that a viable dip that is going to break higher, or is that just the bounce before the next leg down? This is where I think paying attention to key support and resistance levels is pretty valuable to understand, where stocks are actually finding support, where we're actually seeing performance relative to one another. This makes sense given the drop that we had for offense over defense, growth over value, at least during this counter trend bounce. The question is going to be whether you see a reinitiation of some of those forces that really took hold in late February into early March. I think that's what you look for in this week and next week. For today, technology, by far the top performer. The XLK was up 1.6%. Consumer discretionary, number two, up 0.6%. Communication services, up 0.5%. About 50-50 between the S&P sectors up and down today, because you had industrials flat for the day. That means 5 up, 5 down. Consumer staples, the worst performer, down 2.2%. So consumer discretionary versus consumer staples is an important ratio to watch. We call that offense versus defense. Staples have been outperforming consumer discretionary, and it's not even been close here in the last month. And so that would make sense as a counter trend move, is that you'd see consumer discretionary outperform. That's what we're getting. So staples, a lot of those stocks had been really ugly charts for quite some time. Bounced up aggressively in the last couple of weeks. A lot of them either overbought, testing a 200-day moving average, some combination of those things, and now pulling back a bit as the week progresses. Healthcare, number two, down 1%. Materials down about 0.5% today. Looking at the breadth conditions, it truly depends on where you look. So in the growth-oriented NASDAQ, 60% up, 57%, we'll call it 40% down. The S&P 500, a little more value-oriented relative to the NASDAQ, 64% up, 36%, oh Lord, 64% down, 36% up, right? So and the NASDAQ advancers outpacing decliners, the S&P advancers underweighting or underperforming decliners. So the script flipped in the growthier or the value, more value-oriented index. So this is very much growth over value, kind of a mean reversion of the trends we've been observing here going into this week. Finally, looking at the Magnificent Seven and friends, these leading growth names, Tesla continuing a bounce here this week, up about 7.6%. And again, that number looks really good. And my initial reaction, as I'm sure yours goes, okay, maybe the downtrend is over in Tesla. You look at the chart of Tesla, though, and you can see we're still not even we haven't even filled the down day on Monday. So Monday was such a big down day, even with yesterday up a bunch, today up a bunch, day to day, we're still where we were at Monday's open, right? So the percentages can be very deceiving in this kind of environment. Someone actually mentioned on the YouTube channel yesterday in the comment section about how the daily market recap can be very misleading because you're looking at one-day returns. So things feel really good or really bad based on one day's movements. And I don't disagree. That's why looking at that, the daily heat map is helpful as long as you understand you're just looking at one day of trading, right? 2 days move in Tesla is just getting to Monday's open. That's how much of a sell-off it was on Monday. That's how much, ground you have to regain just to recover from that sell-off. So Don't get me wrong, up day on Tesla, but the downtrend is very much in play here and still very much much lower. Nvidia getting a counter trend bounce to the upside, up 6.4%. Netflix up almost 3% today. Apple, the only one of these leading growth names actually selling off today. I did grab the chart of Apple, I believe, to put in the chart review portion of the show, and we'll talk about that continued deterioration. That is one growth stock not bouncing so far this week. All right, let us go to the heat map. As a reminder, I can see some questions coming in on our YouTube channel. I'm seeing some questions on X, and I appreciate you guys watching there. Also on Facebook and LinkedIn, anywhere you're seeing the live stream, anywhere you can put it a comment on those platforms. I can see it during the stream, which is a really cool feature of this platform we're using. I will try to take a question or two at the end, time permitting. Anything we don't get to, we'll put in the chart. This mailbag, we will have an all mailbag episode on Friday of this week, and we'd love to feature one of your questions on the air for sure. All right, let's continue on here. Hold on, I need a piece of paper that is right there. There we go. All right. Looking at the heat map, I actually had this looking at year-to-date changes as we were preparing for the Money Show broadcast. Let's look at just today's trading. I mean, again, a very modeled appearance, right? I mean, what strikes you on this page? I would say there's a lot of green, and then there's a lot of red, and there's a lot of neutral, right? So this very much is another digestion day. And again, that's it's sort of a catch-all phrase I have for not a big directional move, right? You have periods in the market where it is a clear accumulation, right? Where there's just a lot more things up than down. It certainly feels like big investors are accumulating shares in that environment. There are distribution days where, like a Monday, right, where it feels like everything's down, a lot of liquidation, a lot of unwinding positions are happening. You can just tell that by the price action. And then there's a day like today, I would say yesterday, kind of similar, where it's like some up, some down, some neutral. So it really is kind of like a mixed bag of things all fluctuating. And I think this is helpful because there are some times when it feels like stock picking doesn't really matter because it's like it's a macro thing, right? And some things are working and some things are not. There are other times, other days, other periods where it's more of a stock picker's market, where there's more differentiation, where different sectors and different themes tend to move very different from one another. And I think that's what we're experiencing here on Tuesday and Wednesday. You can see a general trend from some of the growthy sectors like technology, consumer discretionary, communication services, with a lot more green than red, certainly in the larger names. Apple aside, all the other sort of mega cap names kind of did well in those three sectors. You contrast that with consumer staples, where pretty much everything was down, kind of down to a lot down. Industrial is very much a mixed bag. Some of the airlines, I don't think I grabbed any of the airline charts, but something like UAL, Delta, all sort of accelerating to the downside. I think, that is one thing that is not sort of taking a break. So one important thing to note is when you've had a big sell-off like the market has had, and then when you have kind of a counter trend bounce, noting which things are not bouncing tells you that it is not a macro reason why those things are going down. They're going down for a legitimate reason. With Delta Airlines, with United Airlines, with the whole travel and tourism trade, this is sort of a general rotation away from that particular theme. Delta, I believe, came out with the announcement that they were lowering guidance because of less demand in the U.S. Someone mentioned in the chat yesterday, which I would agree with. We just arguably a whole bunch of federal employees probably no longer requiring travel here, at least in the for the foreseeable future. That could weigh on certain airlines and certain hubs for sure. So, again, these are stocks that are not getting that counter trend bounce, I would argue are basically shouting at you, not the right time. And so that's what I'm seeing when I'm looking at airlines and others that are just continuing to drift lower. Arguably, there have been signals well before today that a chart like Delta Airlines is not a great chart anymore. But this is basically telling you not the time just yet. A lot of the consumer staples charts, I think there's two kind of general buckets here. One bucket would be like the Walmart, Costco, big box retailer type of bucket. These are charts that actually had been quite strong and are starting to pull back. They almost look more like growth stocks, more like technology names than consumer staples. And they've been outliers in the consumer staples sector for quite some time. The other bucket would be some of these names like Colgate, Palmolive, with an aggressive move off of a low. So, going into March, probably some of the weaker charts you could find, or certainly going into February. And then all of a sudden they've started to rally. And that's been part of the defense over offense narrative that we've talked about. A lot of these names, Brown-Forman's another one with a big bounce off of a February low, pulling back this week. And so I would argue that that feels, at least for now, like a counter trend pullback after a big move higher. And so that's what I would say there. Financials, again, sort of a nothing burger of a day here. Again, charts like JP Morgan remind me of Walmart and Costco. Really strong charts into early mid-February, starting to break down and being less strong here. And again, kind of mixed bag right now in the financial sector. That's kind of where I'm at. The other thing I would say again was something like consumer discretionary, a very mixed results kind of day here. And again, there's a whole. I mean, consumer discretionary is quite a diverse sector. So you have a real mixed bag of different types of businesses, different business models. And again, the travel tourism trade is what jumps off at me with things like Marriott, other hotels struggling. Home builders, I mean, it could be an interesting time in terms of the interest rate environment, but you're really not seeing the emergence of an upswing, right? I mean, I still see charts like Pulte Homes in a pattern of lower highs and lower lows. We'll see. The weekly charts of those home builders actually are starting to maybe look interesting. Once you get a buy signal confirmed from an indicator like MACD or PPO, but not quite there, I would say, based on on a review of the charts. All right, we finish off looking at the chart review portion. Again, I see further questions coming in. Thanks for coming in. I'll take a look in a minute and take a couple as we get to the end of the live stream. But for now, let's look at some charts. So what happened today? I mean, if you look at the move today, that's right here. Look at yesterday's session. They're almost identical days, closing below the open. Even the price range is about the same. So this really was. I mean, today was sort of like an echo from yesterday's trade. No real additional new information, I think, that the market was providing back to us. We were oversold as of Monday's close. Tuesday remaining oversold. Today, the S&P slightly coming out of that oversold region. You know, as we've talked about here, would a counter trend move up to the 200-day moving average make a ton of sense from a technical perspective? It absolutely would. Would I be really excited about buying things at this phase? I would not. Personally, I'm really happy being patient and waiting for the market to tell you that the chart deserves your capital again, or deserves a new long position. I think that's more of a trade, not an investment, as I mentioned on yesterday's show. And that's, I think, what you have to try and differentiate. You know, think about the short term of the tactical trade versus the medium term or longer term, more of the cyclical and secular trades. Those timeframes could be giving you very different signals. You know, the larger themes that we've been talking about, more of the cyclical and secular timeframes, I think have really rotated and continue to rotate from a period of accumulation in 24 to now more of a period of distribution, which is what makes me think that this is just the beginning of what may end up being a much further deterioration. That doesn't mean we can't have some serious snapback rallies where we test moving averages from below, where we test previous support levels, which become resistance. You know, so looking at the chart of the S&P, I think there's room for the S&P to have a counter trend rally up to at least the 200-day moving average, maybe up to 5,800, 5,850. That still would fit in within a distribution phase, I would argue. You have to remember that in a bear market phase, some of the biggest up days actually happen not in big cyclical bull markets, but during bear markets, right? Some of the biggest rallies, these bear market rallies can be quick and sudden. I would not be surprised if we get one of those through the course of this week into next week. That would make a ton of sense, particularly as we're oversold, right? So having recognizing the strength of that sell-off, 10% move is not a small number. So getting a bit of a bounce is often very, very, very common. What I mentioned on previous episodes, and I'll just remind you of today, you know, 10% move that we've had is about the same as we had July 24 to early August 24. That obviously ended quite well as we ended up retesting the previous high, pulling back, and then making a new high. So right about there, I think the S&P looks incredibly bullish in mid-September of 2024. But that 10% move is almost identical, as we showed on yesterday's show, pretty much identical to the first big down move in 2022 after the 2021 bull market, making a new all-time high in January of 2022. We had about a 10% pullback. So a little more, is about 11 to 12% before we had a quick snapback rally that ended up being to about here before the big next leg down that ended up undercutting the low. So that first down leg looks very similar to July, August. Also looks very similar to the beginning of much deeper bearish trends. That's why we always want to take a step back and take a longer term perspective as we get these sort of little moves during the day-to-day, week-to-week fluctuations in the market. So counter trend rally, I think, could make a ton of sense here. I would probably assume that that's a short-term rally within a longer-term downtrend until I see evidence to convince me otherwise. Things that tell me that that's most likely the scenario, indicators that really remain bullish in bullish environments, like the percent of stocks above their 200-day moving average are no longer bullish, right? So holding the 50% level is one of the things that has helped me differentiate from a buyable pullback to something more significant. We're in the something more significant bucket now, with down to less than 40% as of today's close. 40% of S&P members remaining above their 200-day moving average. The percent of stocks above their 50-day is down to 30%. So we're not down in the buyable dips kind of range where we get below 25%, but we're right at 30%. So we're getting down toward that range. I would also say other breadth indicators are not quite at tactical buy signals based on what has often happened in previous markets. This is the bullish percent index on the NASDAQ 100. As of today's close, we're down to around 34%. So about a third of NASDAQ 100 members remain in a bullish point and figure structure. The other 2/3 are bearish at this point. Now, if you look back, the green shaded points over the last year and a half or so are where the indicator has gone below 30%. And so the key for me is when we go below 30% and they get back above it, that has often indicated some really good tactical buy points within a larger structure. We're not there yet, right? We're not down to that point where I could say this indicator is ready to indicate a potential buy signal. So things that often have been good at identifying bottoms aren't to that point yet, which tells me we could have further downside before that sort of pattern would emerge. High yield spreads have widened. That was been one of those things in Q4 of last year and even January, February of this year had not signaled any sort of warning sign. And so, again, there are things that have happened just in the last couple of weeks. Besides the fact that the S&P has gone down a lot, there are other structural changes that tell me that this is more of a defensive rotation. I think bond investors, basically signaling more of a risk-off environment is a big change. And that's a change that's just started to emerge in the last couple of weeks. From mid-February now to mid-March, high yield spreads have started to widen. That's this top panel. And it's plotted inversely just to be more in line with what the relationship traditionally with stocks. So spreads widening basically means bond investors are thinking more risk off as opposed to risk on. They're taking risk off the table, or if they are taking bets in high yield bonds, they're requiring more capital to do so. They're basically requiring more compensation. That means they're a little more concerned than they have been about risky companies or companies of risky debt being able to meet their debt obligations. So widening spreads usually coincide with stocks selling off, and we're seeing that. So we're kind of seeing the double whammy of widening spreads and heightened volatility. And those are things that tend to happen with a bearish market environment. So some of those risk measures that did not look that risky in Q4, certainly didn't look that risky even a month ago, are now changing quite a bit. All right, the commodity space. I don't show commodity charts too often. I mean, I randomly do. I'll show gold and maybe crude oil more than anything. But this is an ETF, GCC, which is basically like an equal weighted commodity ETF. There are a group of commodity ETFs. The DBC is the one that I usually show. That's more weighted by the size of the different commodity markets. So energy is the biggest proportion, biggest part of the commodity space as weighted in that ETF. And so the DBC is really about energy more than anything else. The GCC is a wisdom tree ETF that's a little more broadly weighted across different areas. And this isn't a horrible chart. I mean, it's not a perfect chart. I mean, a great chart would be we're making higher highs and we're sort of above both the moving averages. That's what we looked like in early February. It's pulled back 100% for sure, but still well above the 200-day moving average, kind of in that limbo between the 50 and the 200, but not horrible yet, right? I mean, at worst, it's kind of an okay, but it's not a bad chart. And so that reminds me that there could be interesting charts in the commodity space. Gold, we've covered quite a bit. Natural gas was down quite a bit today. The UNG was down about 7%. But I mean, not a bad chart, right? I mean, if you take a step back and just look at this chart, if this is a stock, would you be comfortable owning it? over the last couple months, I mean, I probably would, right? We went from rotated from a period of distribution below the declining 200-day moving average to now a period of accumulation above an upward sloping 200-day moving average. That's a nice rotation from a distribution phase to accumulation phase. We're making lower lows, then all of a sudden we're making stable lows in Q3 and Q4, now starting to rotate to a primary uptrend. The momentum is kind of in the bullish range. A divergence here in February into March, that's not ideal. A bit of a pullback, possible 100%, but as a primary bullish structure at a time when so many stocks are not showing that kind of rotation, I think that's important. So jotted down a note to look at some natural gas stocks, see what sort of patterns I can identify. So down quite a bit today, 7%, but overall, I think primary bullish structure. Looking at some individual stocks, I want to highlight the chart of NVIDIA. We showed this on the show yesterday, just showing this downtrend channel and illustrating the concept of mean reversion. So the longer term structure has been bearish, but you can often get some really good counter trend moves when you bounce off the lower end of the channel. And sure enough, today, NVIDIA up about 6.4% coming off of that lower end of the channel. This sort of pattern happens often, and I think it's important. Again, not always. Stocks are not always in a really well-defined channel like this, but this is one of those times when it is. And once you know what to look for, they often jump off the page at you. You immediately draw the lines on here, this sort of downtrend channel phase, and then just identify some tactical reversal points between the highs and the lows. Overall, I think this is still a downtrend by my measure, and I would consider this a counter trend bounce within the downward phase. But as a trade, right, as a short-term mean reversion move, I like play off of a lower trend channel. It appears to be what's happening, at least for now, with the chart of NVIDIA. Boy, Apple just really not bouncing here. Out of the Magnificent Seven names, Apple is one that stands out to me as a more negative structure. A break of the 200-day. A lot of the FANG stocks have broken through the 200-day, but are now getting a bit of a counter trend bounce to the upside. You're seeing that with like Alphabet and others. You're not seeing it on Apple. Apple just continuing to go lower, and this is now clearing the 200-day. That's clearing the 38.2% retracement of the April to December rally. So there was a point where it looked like Apple could be a really compelling bounce, but not the case here. So Apple certainly feels like sort of a negative outlier here. I would argue this is a bearish technical structure. Downside objective 200, that would be a 61.8% retracement of that 2024 rally. That would also take us right to the August 24 low. That seems like a reasonable downside objective given the structure that I'm seeing and given the recent breakdown of the 200-day moving average. And again, you could have counter trend bounces, but that level of support, which failed, now becomes resistance. So I think that 225 to 230 range, probably your upside resistance if you get any counter trend bounce. But probably I would be treating, I don't trade Apple individually very often, but if I did, that's a counter trend bounce, and that's where you sort of reinitiate a short position betting on the next move lower. That's kind of how I would generally think of that chart until proven otherwise. Alphabet's another one, right? Breaking through the 200-day, testing it from below, failing to hold it. Again, a break back above the 200-day may make it a little more interesting of a chart. But overall, this is more of a primary downtrend structure. Look at the chart of Alpha. This is one of those, I think, just perfect examples of a topping pattern with a bearish divergence going into a new all-time high of February. The gap lower was not bought. And again, the way I use gaps is you look at what happens after the gap, right? When you have a gap higher and then we continue to accelerate, that means we're gapping higher, which means something new, but then you have additional buyers coming in that are pushing the price higher and higher. Here, we have a gap lower, but we don't have any buyers coming in, right? We don't have people thrilled to get Alphabet at a discount. That's actually met with additional selling, and that selling has persisted. We'll see what happens through this week because we did have a gap down on Monday, but for now, I'm not really seeing a bunch of accumulation just yet. Getting back above the 200-day would tell me, yes, there's accumulation. One thing to note here, and this is one of the many things you've heard me say counter trend bounce a couple times, charts like Alphabet flashing a bullish momentum divergence here, lower lows late February into mid-March on higher momentum. If I'm a swing trader, I see that as a potential short-term bounce. But again, I would still think of that as a short-term bounce until proven otherwise. Micron, boy, what an interesting chart here, right? The semiconductor space has been choppy, but a lot of the semiconductor names have broken down. I mean, Micron, if you look back at the last 6 months, 6 to 8 months, I mean, it's just been sideways, right? You have clear resistance around 110 to 115, clear support around 85. Just yet again this week, we're trading to the lower end of that range and bouncing higher. Charts like this, I don't trade options. If I did, charts like this are what remind me how awesome options can be, because you can use patterns, structures like straddles and strangles and condors and all these different patterns that I don't really know that much about. But I do know that you can play on a stock remaining in a certain range. And straddles and strangles are basically different option structures to basically bet on the price remaining within a certain range or breaking out of a certain range. And that's how you can set things up. And charts like Micron just show you, just being able to swing trade between support and resistance levels using an options trade to basically bet on the price remaining between those extremes. This is why those can be such profitable structures to use. The beauty of options in this sort of chart is the fact that as a long-only equity investors, you're just limited in terms of what you can do when the stock's sideways, right? I mean, you can swing trade a shorter-term time frame, but if you're a medium-term or long-term investor, you're pretty much just waiting, right? You're sitting on your hands and waiting for something to happen. But some of those structures allow you to basically profit from that price remaining in that technical structure. So I would say on the medium term, longer term, until Micron can power above 110 or break below 85, that is a sideways trend. So you either have a way to profit from a sideways chart, or you look and find a different chart that's actually doing something you can profit from. Speaking of charts breaking down and not looking great, Target is it, right? The big box retailers generally have been struggling. Walmart and Costco looked a lot better than Target going into 2025 because they had been such strong charts. Looked a lot more like growth stocks than value stocks. Target was an underperformer of those other two, really gapping lower over the last 2 weeks and continuing to continue to the downside. The reason why I'm highlighting this chart, I'm not a falling knife buyer. I don't generally like to buy things that are super beaten down, but if I did, I would be focused on this chart of Target because we are testing the late 2023 lows. Again, I would consider that a very speculative position, and I would have a really good stop loss strategy in that sort of approach, because if we just continue lower, you're going to get crushed by it. But looking to the left and seeing us at a major multi-year low is interesting to me. It's obviously come down quite a bit in terms of where we're at valuation-wise right now versus a year ago. That's a much better price point, much better entry point. Previous oversold conditions have often had some sort of bounce that can be tradable. So I'm seeing it oversold as we're nearing a key support level. I might be interested in that. By my approach, I'm more of a trend follower, so that's not the type of chart I would usually get excited about. But some of you I know watching are a little more mean reversion type traders, and that's one that would be on my list if I'm looking for stocks to consider. Finally, boy, the travel tourism trade continues to struggle. I thought I grabbed United Airlines or one of those. I just wanted to show the fact that we are now at the 200-day moving average. And, again, if this kind of stock is going to have a bounce, this is probably the general area where I would expect it, given the acceleration that we've seen in the last 6 weeks, given the August to January rally phase, 38.2% didn't even pause there. I mean, we just continue to go. We're now right at the 200-day moving average. I would say between the 200-day and the 61.8% retracement, that means you're kind of between 67 and 71. That's kind of the general ideal place where you'd probably have a bit of a bounce here. We're oversold as we approach that level. Again, these are falling knife charts that I'm highlighting just as examples of things that I might be looking for. Personally, I would be patiently waiting for some sort of sign of accumulation, which I am not seeing yet. A day like today, you're down another 4.7%. But worth noting, in this environment, we have a lot of things selling off. Looking for oversold names, testing key moving averages. That is often a really good place where you can anticipate and often experience a counter trend bounce that could be tradable here. All right, let's see what questions we get here. Someone mentioned, option, bringing on my options friend. You're absolutely right, Danielle Shea. I note to reach out to her to get her on the podcast. I have not done so in too long, and I'll see what I can do. Sean McLaughlin is another options trader that I often bring on. They're always a lot of fun to bring on and see what sort of trades they're seeing in an environment like this. I'll do my best and try to get them on here in the near future. And I appreciate that question. All right, let's see what questions we can get to. Could you comment on Walmart? Yeah, I've mentioned a couple times just the general, observations, but let's take a look at that. Mohammed, thanks so much for watching on YouTube. So here's the thing, right? I think there's the short-term call and then the long-term call, right? We'll start with the big picture. The problem I have with charts like Walmart is they've definitely changed, right? And what has changed on the chart of Walmart from mid-February to mid-March, right? 4 weeks have made a huge difference. Number one, you have to remember that coming off of that long-term high, the initial gap lower took us down just below $100 a share. And that was one of the things I remember seeing on the chart of Walmart and thinking, ooh, big round number. And we've now gapped below that. So that logically becomes a key resistance level. And for now, it's definitely held. After the gap, we traded lower and then didn't even get back into the gap range. And so this really suggests a rotation from an accumulation phase to a distribution phase. And what does that mean? That means gaps aren't being bought, meaning you don't see the stock gapping lower and then a bunch of buyers coming in. You're seeing further distribution. We're seeing a pattern of lower highs and lower lows. The RSI well below this bullish range. Look at how the RSI in the year of 2024 often becoming overbought on rallies. The pullbacks remaining above an RSI 40 level. All of that has changed here in the last couple of weeks with the RSI plunging below 40, and now actually resting below 30. So I would say the primary structure appears to have rotated a little bit. What would you be looking for? In terms of counter trend bounces, looking for key moving averages. We're nearing the 200-day. Looking for oversold conditions. The first time we're oversold since 2022. So it's been quite a while. Might have been actually early 23, just to the left there when we were last oversold. But it's been quite a long time. So again, given the primary downtrend of lower highs and lower lows is not encouraging. Now, Walmart is actually holding the 200-day moving average for now, right? This is one of the less than half of the S&P members that are actually remaining above their 200-day moving average. With any chart that I will show you, holding the 200-day is usually pretty important. Failing to hold the 200-day is often a sign of further deterioration. I would say that's where I'm at with Walmart. Again, pullback has been significant. Counter trend bounces would be pretty reasonable to expect, especially off of the 200-day moving average as we get to an oversold condition. But the primary structure appears to be bearish by my reading. All right. Random Q Hacker, great handle. Would love to know where you think TLT is heading. Let's take a look here. So, where would I go there? Intermarket. I have a chart, a list of intermarket analysis charts, and let's look at the TLT. So, the chart of TLT, I would say, the primary trend appears positive to me. And I would tell you by the fact that we have this big trend line for the September high and the December high and the February high that was broken in late February. So lower highs, lower lows appears to be changing. Now we've rallied quite a bit higher. We had this gap on the TLT in mid-February, now pulling back a little bit. I would say breaking above this kind of neckline, this could end up being like an inverted head and shoulders pattern, which I think we mentioned on yesterday's show. But that would mean you see where this right shoulder forms. And if it's parallel and the neckline, the breaking above that neckline, I think would be a big sort of buy signal, a real bullish follow through signal for bonds for the TLT, and would suggest interest rates probably popping lower. We're getting a bit of chop around here as we have inflation data today and tomorrow. So we'll see what happens after those things are released. I mean, I would say if you agree with me that the chart's generally trending higher, what you can often do is then switch and say, all right, we're now in an uptrend phase. So I'm going to draw a trend line off of the low. So there's the low in January. Here's the low in February. There's the room we have to continue to pull back and still be within a very clear uptrend structure of higher highs and higher lows. We start breaking that trend line, I think you need to reevaluate a little bit. But overall, the way the momentum has shifted, the way the trend has shifted after that trend line break, I see bond prices as generally going higher here until proven otherwise. Again, the way that I tend to think about charts, anytime I bring one up, is I immediately think, is it guilty until proven innocent or innocent until proven guilty, right? So if a chart is in a primary uptrend, it's innocent until proven guilty. Wait for the chart to tell you it's no longer going up. If we're in a downtrend, we're guilty until proven innocent, right? What would you need to see to turn bullish? And I would encourage you to think of that. I mean, again, you use as much of a structured approach, a checklist style approach as you can to evaluate a chart, but then come to that point and then decide what would tell you that the perspective, that the vote has to change. Folks, that'll do it here for today's show. I want to thank you so much, those of you tuning in live on the different platforms upon which we are live streaming. And thank you again, those that are watching our replay on our YouTube channel. Thanks so much for supporting me as we've gone and created this show. We're about 6 months in, I want to say. I haven't tracked how many episodes we've done, but I'll probably start counting them and try to figure out which episode we're on so I can announce when we get to some big milestone episode. But I'm pretty happy continuing to do this market recap show every weekday after the close. As a reminder, check out our Market Misbehavior podcast. I sat down with Ryan Redfern of Shadow Ridge Asset Management in Austin, Texas. He's the president of NAME, the National Association of Active Investment Managers. As soon as we're done here, I'm going to go finish editing that episode and hopefully get it out to you very soon. But that was a must watch because we talked a lot about just the mental challenge of dealing with this market, what he is doing to coach his clients on how to navigate through it. He had a very optimistic view of what he's seeing in the markets. And I think it could be a good counterpoint to some of the charts that we've been reviewing on the show. So I hope you'll check that out as well. But for now, I wish you a wonderful night. Thanks so much for watching. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Take care, folks.